Good to be with you again. This is Bob Carey with First Trust. It is the 19th of June. The markets are rocking today. In fact, so far this month, they're doing exceptionally well. It looks like sell in May has turned into buyback in June at higher prices. Unfortunately, for a lot of investors, I think that's probably what's been happening here as of late. The market, as of right now, the S&P 500 is up 8%, excluding dividends. If you throw in dividends into the S&P 500, you actually have a 9% return year to date. It's amazing. Just a few weeks ago, we were actually in negative territory for the year. So obviously, we've seen the market rebound. I think fundamentally what's happened is the market has been expecting bad news out of Europe, a financial contagion that hasn't happened. We clearly have systemic risk levels at a higher level than we had, say, at the beginning of the year. However, we're not seeing widespread panic selling, if you will, of financial assets. And the fact is that the economy is still rolling along, not necessarily growing fast, but as my colleague Brian Westbury has said many times, we are growing like a plow horse, just kind of moving along. Now, we heard from a couple of major companies here today. These companies report earnings on a different cycle than the calendar. The two companies I'm referring to are Oracle, the big software company, and FedEx, the big transportation shipping company. Both companies handily beat their earnings estimates, and buried deep in the earnings release and then in the conference call for FedEx is their expectation that the economy in the United States continues to grow at about a 2% pace between now and the end of their fiscal year. So clearly not a recession, not a boom either, but investors were undoubtedly selling financial assets just a few weeks ago, thinking that we were heading for another recession and perhaps another downturn of the market of a severe magnitude. That hasn't happened. The market's been recovering. Very similar dynamic overall to what we saw back in the third quarter of last year and also the second quarter of 2010. Now, obviously, we went down 20% in the third quarter last year. We went down about 10% in the second quarter. This correction, as it turns out, it's about a 12% correction. So very similar sort of a situation where investors effectively were shaken off the market, and here we are, we're recovering, and investors in many cases are just starting to get back in, realizing that they made a mistake and getting out. Now, as far as opportunities within the market, we see a very wide divergence right now in valuations. Maybe disparity is a better word. In other words, a very wide gap in valuations between companies that are in cyclical industries affected by the economy. They could see earnings go down if the economy were to go down, and companies that are in stable industries, non-cyclical industries. Think about consumer staples companies, the telecom services companies, and utilities. Investors like those stocks in those sectors because of the defensive nature of those companies. Those stocks did very well in the second half of the year last year, and investors ignored the fact that utility earnings were actually down on the year. It didn't matter. The sector was one of the best performing sectors in the market. This year, we're seeing areas of the market such as technology, the consumer cyclicals, not the non-cyclicals, but the consumer cyclicals as opposed to the staples, have done the best. The market, I think, is beginning to adjust to the fact that we've seen very good earnings performance from these companies in these parts of the market. So we see a lot of value. We expect that to continue. Obviously, we are a few weeks away from the end of the quarter, and in about 3 weeks, 4 weeks or so, we'll start to see all these companies' earnings reports. The Fed is meeting as I'm speaking. Obviously, we're going to pay very close attention to that. But overall, we feel very good about the recovery in the market. There's a lot of potential for this market to go up substantially here over the next couple of months. We're just a few days away from summer. And in the meantime, be safe out there, and we'll talk to you next week.